Good morning, everybody. This is Kathy with Premier Companies. How are you doing this morning? I have with me on the phone Jay Ager from One America. Good morning, Jay. How are you doing today?
I am good, Kathy. Yourself?
I'm doing pretty good. You kind of scared me. You took a second to talk. I thought maybe I lost you in that
I,
transition.
I'm here.
Okay, wonderful. Well, I know we've been talking a little bit about going back and forth and kind of helping me with this presentation. So I'm just going to let you start and take it away and kind of explain to everybody what we've been talking about.
Okay, outstanding. Thank you very much. Thanks for having me on the webinar. And for everybody on the call today, thank you very much for attending. I know webinars can sometimes be difficult, so I will make sure that I try to make it as entertaining and useful as possible. So thanks for taking time out of your day. Just a couple of notes that I will give you guys is I am going to cover a lot of information. So make sure that you've got a pen and paper handy. I know how easy it is on a webinar to get distracted, start checking your phone, your email, wandering around, thinking that listening is enough. But sometimes you need to see the stuff too, and I'll try to ring you back in when there's something really important I want you to see. But have a piece of paper handy for notes as questions may pop up, and even for clients that pop into your head that you start thinking about, because I have a feeling that you will absolutely think of some clients. So, whoops. All right. Okay, look at there. And you can type your questions in there, and hopefully we can go over them over the end. Look at that. Kathy is on the ball. So we're going to go ahead and get started to get you guys through the presentation and on your way as quick as possible here. So housekeeping items. Everybody read the disclosures? Good. I always like to start with the company. Obviously, as we're talking about the long-term care space, there's a lot of stuff going on right now. So understanding and being comfortable with the financial stability of the carrier you're working with, I think, is very important in this space. So we have the A+ rating. We have a 95 Comdex. We are also a mutual company, not a stock company, so I'm not sure if everybody on the call is familiar with why that is different. But stock companies, every single quarter, have got to report to the stockholders where their current profits and losses and everything else are at. I came from a company recently where they were digging in the couch cushions every single quarter to report to the stockholders. As a mutual company, we invest for the policyholders. We don't have to scrounge around every single quarter to report numbers to try to make stockholders happy. So as a mutual company, we are able to invest a little bit differently for our consumers. So I think that is a very big point to think about in the carrier, as well as you guys have got to have information when you're going to a client that's relevant to the client. And clients may understand that A+ is good, 95 is high, but they may not really know what that means. So if you're looking for a one-liner about the company, this would be the time to kind of listen, is in 2008, I don't think it would surprise your clients to know that almost 29 insurance carriers were financially downgraded. It was a very bad year. However, you can tell them that the company that you're sharing with them today was actually financially upgraded in 2008. That tells a very compelling story about the carrier that you're representing. I'm not going to spend a ton of time on this, guys. This is stuff you've probably heard repeatedly and over and over and over and over and over in regards to the average cost of care. And if you add inflation, we all know that care is expensive. We all know that inflation, just like taxes, are probably going to go up. We know that the advancements in medicine, people are living longer. We know that medical costs are probably going to go up. And I'm not sure if you knew this or not, but the #1 fastest growing career in the country, probably the top 3, are home health care providers, nurses, things like that to help for these particular situations. And part of it is because #1 on your screen, this is something I really want you guys to think about and let this soak in. Everybody hears on a regular basis that there's 10,000 baby boomers a day turning age 65, right? It's the #1, oh, we're income planning, yada, 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 65, still that golden number. We've been saying that for 5 years. That means that there are 10,000 baby boomers a day turning 70. That this is the first wave of required minimum distributions being first at 10,000 a day, that not all of those clients know exactly what they need to do with, because they may or may not need it for income. So I really want you thinking about that. Here's one of the other things. This is, again, with inflation. One thing I point out here, if you guys don't have it, jot a note down to yourself, if you're still with me, is there was an article about 3 months ago in USA Today, is talking about if clients have $730,000 allocated for care, they might be okay. And that's talking about the 8-year average for Alzheimer's patients at today's cost would be roughly $730,000. And as we know, most clients don't have that much money set aside just for care. Now, I'm going to talk a very short statistic because I know this is something that a lot of people use. In regards to individuals over the age of 65, have a 70% likelihood of needing some sort of care. I really want to break that down into a yellow pad sales idea. So again, if you've wandered off, if you started checking email, come back. I've got a quick napkin sales idea here for you where you can draw this out anywhere. So if you use the statistics, is to say, look, Mr. and Mrs. Smith, the statistics say individuals over 65. So that means for him on the left, 70 yes, 30 no. For her, 70 yes, 30 no. So if we look at you as a married couple versus individual, that means there's almost a 50% chance both of you are going to need care. 21% chance that one will and one won't, and only a 9% chance that neither one of you will need some sort of care in your lifetime. Now, I know this is a lot of numbers and information to think about, but the reality of this is that means there's a 91% likelihood in a married couple that one of you is going to need some sort of care. And this is another line, I'll probably say it repeatedly throughout this presentation, and if you do not allocate some of your money for care, you are allocating 100% of every dollar and asset you have. Okay? So if you use statistics, again, this is just a quick way to show somebody statistically the odds of a married couple needing care. Now, one of the ways that I'm hoping people are introducing this, and especially if you're a man on here, if you're a guy and somebody says, well, there's a 70% chance you're going to need it and a 30% chance you won't, almost every one of us will say, I'm in the 30%, right? So what if we said, you know what, you may never need care. You're right. You may be in that 30%. But let me ask you this. Play this out with me. If you did, how would that affect your wife, your kids? You got to start thinking about the consequences, not just the financial and everything else is, you know, what's the consequences to a spouse? If you guys have not heard this or seen this, but healthy spouses taking care of a chronically ill spouse, will they themselves become chronically ill? A shorter way to say it is healthy people taking care of sick people, will they themselves become sick? There's a lot of ways to look at that, but you guys know this. So I would be willing to bet everybody on this call has either had some personal experience or knows of a story where there was a spouse that, you know, things couldn't do right. The kids, you know, one kid ended up taking responsibility, the other ones didn't want to help. They didn't talk to a sibling for years. And as a father of 4 daughters, I don't want something that I didn't plan for to create dissension amongst my kids. So to think about it in what if, and then continuing this out, if you did on the financial side, how would you pay for it? Where would that money come from? Is Medicaid going to take care of you? Do you know what it takes to be on Medicaid? Is Medicaid the same today as it was 5 years ago, 10 years ago? Do you expect it to be the same 10 years from now? Are you self-funding? For anybody that says they're going to self-insure, correct them. Insure implies leverage. And when they are self-funding, they're paying for it dollar for dollar. They're not leveraging anything. And is your current, if you have traditional long-term care insurance, is that policy enough based on where things have gone? Now, today we're going to talk about our two products. Okay, now you see a bunch of stuff on your screen right here. In reality, we have a life insurance policy and we have an annuity. That's it. Okay, so if you think about it that way, on the life insurance side, it's just a matter of how you fund it. Okay, so on the annuity side, they're all single premium, so it's a matter of how you want it built. But if you try to keep this as simple as possible, is everybody understands how life insurance works, everybody understands how an annuity works. It's how we build the care on top of that base policy. So before we get into the hybrid products, though, this is another yellow pad sales idea that I want to give you guys, and this is the one in regards to bridging that gap. So again, if you've started checking email or filing or whatever else, come back. I've got a quick sales idea for you again on a yellow pad that has really helped a lot of people bridge that gap of traditional long-term care and a hybrid product. Because traditionally, people have looked at handling this need one of two ways. I either have to buy a traditional long-term care insurance policy, or I'm just going to self-fund, right? And the reason that people buy, and if you're presenting this to a client, ask it as a question. Now, Mr. and Mrs. Smith, I know that you may or may not have traditional long-term care insurance, but why do you think most people buy it? Typical responses are, well, because someone in the family had a need, they wanted the protection, whatever. And it's like, yeah, that's part of it, but the other part is they wanted comprehensive coverage. They want, as I say, baby boomers want what they want, when they want it, and how they want it. So if I'm wrong, please let me know. But they want something that can give them care at home, so home care, assisted living, adult daycare, nursing home, respite care. They want all the bells and whistles if they're going to pay for it. Now, the reason a lot of people have not traditionally got it, and again, the client will tell you, well, if I don't use it, I lose it. It's expensive. The cost can go up. It's a variable expense. I never know from one year to the next what my premium's going to cost me. And on a fixed income, that scares me. So that's why I self-fund, because if I don't need it, then I get to keep my money, right? I didn't need it. I was in the 30%. I get to keep my money. And then you say, well, what is the downside of that again? If we play this out and you did need care and you were self-funding, well, at $80,000 to $90,000 a year on average, you could lose everything. Now, if it's a married couple, again, you could lose everything, and where does that leave your healthy spouse? Is that a position you want to put her in if you did need care? So let me ask you this. If there was a care solution that would allow you to bridge the gap and win this game of tic-tac-toe diagonally, where you had comprehensive coverage, so assisted living, home health care, respite care, adult daycare, all of that, if you needed care. But if you didn't, and you passed away, there was a tax-free death benefit that went to your beneficiaries. If you changed your mind, there was cash value, potentially return a premium day one. If there was a way to bridge that gap, is that something you would be willing to sit down and have a conversation about? And most of the time, people are like, well, yeah, but how can you do that? And that's exactly why you guys are on the call today, to find out how we can do that. So here's the concept in general. So if you looked at somebody's portfolio that was self-funding, right? They have money in conservative, aggressive, moderate, they're diversified. If they have a care need and they need to start accessing money to pay for it because their income is not enough, the wife wants to maintain her standard of living with whatever they're getting on an annual basis, typically they're going to go to the conservative money first, right? The CDs, the money markets, they're not earning a whole lot of interest. It's accessible. And 9 times out of 10, the money in these conservative accounts are rainy day funds anyways. And if you ask your client, if that's rainy day money, what's a rainy day? Well, if I have medical, if I need this, if I need that. And this goes directly to, and guys, one of the things I would tell you if you're doing napkin sales ideas is to draw this circle on a napkin with somebody Make the triangles and say, you currently don't have a plan. And as I said, if you don't allocate some money, you're allocating 100% of every dollar and asset inside this circle. So if you had a care need, not saying you will, if you did, point to where you would start withdrawing money. And I promise you it's going to be one of those conservative accounts first, because is it going to be aggressive if it's 2008? Absolutely not. Now, if they need care and don't have a choice, they're going to get money from wherever they can get it, because if you need care, you're getting care. So this is a deal to say, what if they had $150,000 sitting in a CD? That's their rainy day fund. And you told them, look, if you went to your banker because you had a care need to pull the $150,000, how much is he going to give you? $150,000. Well, what if you passed away and your kids came into the banker and said, hey, mom's been rolling that 5-year CD for 40 years. We want the $150,000 CD. Is the banker going to give it to them? No, right? CDs go through probate. So you've got to hire a probate attorney. It's public knowledge. And depending on the amount of assets, could take some time. So they may not end up with all $150,000. And if I told that client, this is your rainy day fund in your left pocket, what if I told you if you moved it to rainy day pocket number 2, you put it in your right pocket, and if you needed care and came to me, instead of $150,000, you had access to $300,000 for care? Have I improved upon your rainy day fund? In your lifetime, will that $150,000 in a conservative account ever grow to $300,000? The answer is no, not your lifetime or probably your kids. Maybe not even your grandkids. So if I've improved upon your situation, if you needed care by doubling it day 1, and if you passed away, say you never needed care and you passed away and your kids came to me and said, hey, mom did have her rainy day fund over there at the bank. She put it with you. How much do I get from her rainy day fund? Oh, well, you get $300,000, 100% tax-free. As soon as I get the form sent into the insurance company, they'll send you a check. Now tell me what client, if they have $150,000, and by the way, guys, if sometimes I know a lot of advisors that shy away from CD money and everything else because there is the mentality, it's down at the bank, it's the brick and mortar, blah, blah, blah. I can help with those kind of objections as well. But which one of the clients, how many of them would not be interested in doing something like that? It's still their money. Remember, there's death benefit, there's cash value, there's a care benefit, and they have the ability, if they want to make that last their lifetime. So here's our first policy. This is our single premium policy. Again, remember I told you on the life insurance side, it's the same product. It's just a matter of how you fund it. So on the left is the policy that they would be buying, right? So there's their $150,000, and notice at the top, this is a married couple. One of the unique features, so again, if I've lost you, hopefully I haven't, but if I've lost you, come back. One of the unique features about our product, and it's got a patent on it, is being able to put 2 people on one policy and create lifetime benefits for both. Okay, so this is a 64-year-old married couple, which if you're an agent, you've got these clients. If they had $150,000 in a rainy day fund, moved it to the right pocket with you, created this $300,000 tax-free death benefit, would create $6,000 per month per person. Now, all of you are in sales, all of you are in marketing. You tell me which sounds better, $6,000 a month per person, or to say if you have a care need, it'll generate $72,000 a year for you and your spouse if you need care. Now, here's the thing I want you to think about. This is money they already have. So this base policy, that $150,000 is money they already had. That's just left pocket to right pocket. So what you're really selling is to say, look, now that we've created this benefit, if you would like to make sure that that $72,000 a year, guaranteed, tax-free, for you and your spouse to last the rest of your lives. So if you need care, for 3 years or 20 years, it'll still continue to pay. You're looking a little under $1,500 a year. I'm talking about two 64-year-olds. If you guys have ever sold traditional long-term care, and this whole webinar was solely about selling a traditional long-term care policy for two 64-year-olds to guarantee them $72,000 a year, 100% tax-free, and the $1,500 a year was guaranteed to never increase, is that a traditional long-term care policy you could sell? And the answer is yes, every day of the week and twice on Sundays. And that is exactly what you have with the One America policies, because that rider is a true long-term care rider. So what that means is if these 64-year-olds are still working, they can use HSA money to pay for the rider. Okay, if based on their income and age, adjusted gross income to 10%, we can send you all that information. There could be some deductibility, right? It is true long-term care insurance. It is guaranteed to last for the entirety of their lives. Okay, so some of the other things people like to talk about is statistics in regards to, well, the average stay for men is 2.2 years, and the average stay for women is 3.7, blah, 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 blah. Those stats don't talk at all about how long somebody was receiving care at home. And again, how many of your clients are average? I've been doing these around the country, guys. I've ran into 2 people with clients under the age of 50 that were diagnosed with Alzheimer's. A lady's client's son at 29 was diagnosed with Alzheimer's. Do you think that that guy at 29 years old, diagnosed with Alzheimer's, is only going to receive care for 2.2 years? Absolutely not. Okay? So the idea here, especially with married couples, guys, this is an incredible opportunity to have lifetime benefits with a guaranteed premium. Now, if they wanted to, let's say that they didn't want to pay the $1,500 a year on an annual basis, right? People over 55 are statement people, not bill people. If they wanted to, we could say, okay, and you don't want to put more money into it, let's split the money up. So let's put $128,000 into the life insurance policy, and let's pay up the lifetime rider in a single premium. So now you have traditional long-term care insurance that can be paid up or have guaranteed premiums. Okay? And yes, this is real. So if you've sold traditional long-term care insurance, please don't be skeptical. We've been selling these policies for 30 years. Asset Care One was actually the first hybrid product like this on the market. So we're not new to this. We didn't just make it up, even though the hybrid market is a fairly new one. We have been doing this for a very long time, okay? So you'll see that this situation, it lowered their benefit. It's still $60,000 a year, 100% tax-free per person, but it's paid up, and it's guaranteed for both of their lives. That is an incredible deal. Now, this particular, here's the one thing that I want to tell you guys, and please don't get super confused on this. I want you to stay high level. Someone wants lifetime benefits, they have that option, and if they're using a single premium, Asset Care One is where you want to look. Some of the things that the group at Premier can do is they can help modify this. So this previous slide, where you're seeing this $5,180 per person, that's based on taking 50 months to withdraw the death benefit from the base policy. So if I pulled $5,180 a month, I could pull that a month for 50 months, and then my base policy would be gone. If both clients, so the husband and the wife, pulled the $5,180 each, so they're pulling out $10,300 and some dollars, then the 50 months would shrink to 25 months, right? We have the ability to say, well, maybe that's not enough. Maybe the $5,180 isn't enough, so let's shrink it down to 3% of the death benefit and have it pay out over 33 months, or 4% of the death benefit and have it pay out over 25 months. Now, as you can imagine, the rider cost will go up. The sooner you're drawing down the death benefit and dipping into the insurance company's pocket for the rider benefit, the cost of the rider will go up. The exciting thing is it's not substantial, guys. I can tell you right now, rule of thumb, about 90% of the illustrations that we run are ran at a 4% of the death benefit. It creates a bigger benefit day one, and then they're into the client's pocket faster because once they get into the rider, if they didn't pay for it in a lump sum, there's an automatic waiver of premium on the rider. So with 25 months, 4% of the death benefit, I get a bigger benefit. I draw my money down quicker to get into the insurance company pocket faster, and once I do, there's no more premium that's got to be paid. Okay? So a lot of ability. So the one thing I want you guys to hold on to again, excuse me, if you've wandered off on me, is that we have the ability, and Premier is incredible at finding a way if a client has or needs to be introduced to some sort of care, because again, if they don't allocate some money, they're allocating all of it, that they can modify the plan to fit the client's needs. Okay, so now if someone has qualified funds, which is a lot of your clients, as well as the fact, remember I said 10,000 a day, turning 70, and that's for the next 18 years, right? And RMDs don't stop the first time you got to pay them. You got to pay them every single year as long as you have qualified money. This concept creates it all in-house to where what someone would do, and this, I'll tell you, I had a client where the guy had $1.2 million in liquid assets, not liquid assets, in assets, 982,000 was in qualified funds. So we had to look at something with this. So we did a tax-free transfer of the 401k money into an IRA at One America. So it's just a transfer, so you can go IRA to IRA, and then what it does is it will 20 pay, so annually took out $8,000 a year, paid the taxes on the $8,000, because with Uncle Sam qualified money, he's going to get his. But you didn't pay taxes on the full $125 every year. You'll get a 1099 for that, or the client will, for that $8,000. Now, this will satisfy the RMD for the 125, and it'll take a chunk out of the total RMD as well. So we're helping with something they have to do anyways at some point. And just like any other life insurance plan, that initial $8,000 premium pays for a life insurance policy, which guarantees a death benefit day one of $133,000 tax-free to the heirs. So there's an element of estate planning to, because after the first payment, there's still $117,000 in qualified funds. So if the individual died, the taxes would be due to the beneficiary on the $117,000, and they now have $133,000 tax-free benefit to help offset that. Now, we're buying this for care, and in this example, we have a joint. That's the other thing to think about. So if I've lost you, qualified money coming over to the Asset Care 3, you can add a spouse as an additional insured. I can now cover 2 lives with 1 qualified dollar, okay? And the death benefit is initially based on what's remaining in the IRA as well as the death benefit that's created day one, okay? So initially it's based on both, and then here again for a 64-year-old male, 60-year-old female, for just over $1,000 a year, I can make that last a lifetime. Now, bullet point, asterisk, disclosure, whatever you want to call it, the rider does have to be paid for with non-qualified dollars. So again, they can use the money out of their HSA to pay the $1,000 a year if they want to. They can also, what this individual did is transferred $125,000 to the Asset Care 3, and then I believe we put $26,000 somewhere in there into a qualified SPIA, and had that SPIA do a 20 pay directly to the rider. So then he was paying the taxes over 20 years, but at the end of the 20 years, the rider and the base policy were paid in full. So again, don't get caught in the weeds on this, guys. What I want you to understand, $10,000 a day turning 70. Not everybody needs it for income. Majority do not have a care plan in place. This will automatically handle the R&Ds, and it can create a benefit to last the rest of their life for them and their spouse with one qualified dollar. We can build the plan later that best fits your client. Know that it's available. All right, this is our fastest growing product. This is our Asset Care 4. This is our continual pay. So like I said, our policy is exactly the same on the life insurance. It's a matter of whether you're paying with a single pay, qualified money, or continual pay, because not everybody has $150,000 sitting in a rainy day fund. It needs to be a budget item. So two 55-year-olds, still fairly young, still working, created with $2,550 a year, $125,000 death benefit, which gives them $5,000 per person. So again, $60,000. And for $1,400, they're able to guarantee that for both of their lives for the rest of their lives. Okay, so think about that. For both of these, they're paying just, what is that, just under $4,000 on an annual basis, and this is a fixed cost. This is not a variable expense. That is not going to change. It's not going to go up. It can't. It's non-cancelable. It's not just by current company practice or not raising rates. It is contractually locked in. We cannot change it. And again, 55 years old, they're still working. They're paying for that $1,433 out of their HSA. So in their minds, they're paying $2,500 a year to create $60,000 per person in tax-free income for care if they need it. Something else I want you guys to think about, since those are guaranteed, this is a policy that me and my wife are looking at. I'm younger, I'm 39, she's 37, but for me to create $8,000 a month, and again, I'm not selling $8,000, I'm selling $96,000 a year for me, $96,000 a year for her, and I'm paying just over $4,000 a year guaranteed. My HSA is paying for the majority of my rider. Okay, and that's locked in. So younger people, because I'm never going to be healthier than I am today, allows me to create this benefit for me and my wife should anything happen. Here's another example with me and my mom. You can have just insurable interest, guys. So if you have parents maybe wanting to gift money but are worried about certain limits, if you've got this, so if me and my mother, because if my mother bought this at 61, her benefits wouldn't be as great because we take the joint age. It's a joint policy. We use joint age. I create a bigger benefit for her should she need care. And by adding the lifetime rider, I've got a residual benefit for myself. Okay? Here's how we look at it, because I know a lot of you have looked or have sold traditional long-term care. If you've ever in your life, and you can ask your clients this, if you've ever rented, right, most of us probably had, because for whatever reason we did. And renting was typically cheaper. So I could pay less, but I did not have any equity. I had no cash. And my rent, inevitably, every year ended up going up by a little bit every single year. So, but if you owned a house, your house payment may be a little higher, but it's fixed. Usually you got a 30-year mortgage. And as you pay down that mortgage, you're gaining cash value, you're gaining equity. If something happened to you, you have something to leave to your kids. And that's really the story between traditional long-term care insurance and, for, say, an Asset Care 4, where it may be a little more expensive. But you have a tax-free death benefit. You have money for care. You have cash value. For example, my policy I just showed you, after 12 years, the amount of money I've paid in, my cash value is equal to that. So after 12 years, I basically have a return of premium of all the payments that I've made. So it's just kind of a way to help wrap your mind around it. You saw the tic-tac-toe idea. This is another way, renting versus owning, in regards to traditional versus ours. Now, I want to hit on the annuities. This will be something easy to grab onto now that you understand how the policies work. But something to think about, guys, is there's over $60 billion in non-qualified annuities. And if you think about it, even if you're not selling annuities, back in the day, most people were selling fixed annuities as a CD alternative, right? So rainy day money that was in CDs, people would move to annuities because it created a tax-deferred rainy day fund, right? So that's where the majority of those went, because right now, of that $60 billion, statistically, most of it's going to end up in the hands of a beneficiary, because if they go to withdraw it, it's taxed. All of the gain is taxed first before they get to their cost basis. So what the government did in 2006, they wrote into law the Pension Protection Act changes that took effect in 2010 that says if you transfer an existing non-qualified annuity to a PPA compliant annuity, every dollar you take out for care is 100% tax-free. Guys, this is huge. Case in point, had a client that had a $200,000 non-qualified annuity. Her original cost basis was $50,000. All we said to her after we found out that it was not being used for income is if there was a way to eliminate the tax burden on all 150,000 of your tax-deferred growth, wipe out the tax burden of that, and protect your income for your fixed and discretionary expenses and your other assets, is that something you would be willing to sit down and talk about? Answer was absolutely yes. She moved it into one of our policies very quickly, right? People that have accumulated wealth like that do not like to pay taxes. So if all you did was send out a letter to all of your clients that said something like, do you have any non-qualified annuities not being used for income? Did you know about the law changes that allow you to pull out that tax-deferred gain 100% tax-free? If not, call me and show them how this works. And it really is the same thing as the other policies. Here's an example of our fixed annuity with an optional lifetime rider. 81-year-old female with $125,000, did not want to pay for the rider on an annual basis. So we split the money up, 102 into the annuity, 22 to pay for the rider. So she was done, created a $36,000 a year, 100% tax-free benefit. So I took a non-qualified annuity and made it as good as cash because it was tax-free. I made it as good as life insurance because it was tax-free and guaranteed for the rest of her life, no matter how long she needed care. So we have a fixed annuity with an optional rider. We have a fixed annuity with a built-in rider. So this is our most popular because the rider is automatically included. You put in $100,000 and the cost automatically is peeled from the accumulated value to pay for the rider. And your clients choose which rider. Do you want 2.5 times leveraging, 4 times leveraging, or 5.5 times leveraging of your money? And again, if you guys have got clients with non-qualified annuities that are not being used for income, call the folks at Premier and we can explain and run through the numbers and help you decide, help your clients decide which one of these would be the best option for them. We are the only ones with an indexed annuity with a true long-term care rider that creates an optional lifetime benefit for your clients. I call this because almost 80% of indexed annuities sold are sold with an income rider. So this is my income protection rider, right? Because indexed annuities that have the income riders are built for fixed and discretionary expenses, right? They're not built for a possible care need. And the number one cancer to any income plan your clients have is a care need. So why not allocate some money instead of all of the money into a fixed indexed annuity with an optional income protection rider? Now, just like most index, whether you sell them or not, there are multipliers and advantages to doing so. So this is an example of somebody who put in $135,000. If there was no growth in 20 years, that bottom line there in the bar, you'll see that there's a 1.5 times multiplier. There's a 50% bonus If there's no gain, there's a 50% bonus for care need. So no growth in 20 years, $135,000 deposit, still has over $200,000 available for care 100% tax-free. If they do have some growth, which hopefully they will, because if we have no growth in 20 years, we've got bigger problems. But the multiplier is less, but it's still a 15% bonus on the accumulated value in this scenario created $290,000. So from a $135,000 deposit, we've created almost a $300,000 benefit, 100% tax-free. So if you guys want to learn more about that, you can go to the website, indexedannuitycare.com, get some information. I highly recommend contacting the folks at Premier first. They will be able to point you in the direction of which product is best suited for your client based on their needs, whether it's a budget item, a qualified money item, a health item, whatever it may be. And speaking of health, this is underwritten. Okay, I'm not going to be able to offer lifetime benefits without underwriting. So on the life insurance side, it is fully underwritten because we're underwriting for life insurance and for long-term care. So we're underwriting for both. I feel like we are a very liberal underwriting. If you look at this, I mean, a stroke after 6 months, if it's a single episode, you can still qualify for a life insurance. Diabetes could still qualify for life insurance depending on severity. So there's a lot of things in here. And again, if you guys have wandered off, come back to me. Premier has access to a pre-underwriting form that you can fill out, email in, and very quickly get a response on what they would qualify for if there was nothing else that popped up. Just to give you an idea of how liberal, 410 can weigh 222 pounds and still qualify for our life insurance. Okay, I'm 6'3" and could weigh 372 pounds and still qualify for the life insurance. The annuity underwriting is substantially easier because I'm not underwriting for death benefit. So on the annuity side, it's some knockout questions on the application and a 15-minute phone interview for cognitive. Where else in the world can you create a tax-free lifetime benefit for long-term care for a 15-minute cognitive phone interview? You can't. Again, they say don't ask questions you don't know the answer to. Last thing before I let you guys go is there's some niche products. I'm not going to spend a lot of time. I want you to know that they're available. You can contact the folks at Premier if any of these trip your trigger. We have a transfer annuity. The purpose of this is because a lot of companies do not allow or will not facilitate a partial 1035. So what we've done is developed a transfer annuity where instead of walking away from that sale, you can transfer the entire thing to One America, and we will facilitate the partial 1035 to whatever One America product you want to buy, and then send the rest to whatever other company you want it to go to. So an example, if you had a $400,000 and the client didn't want to put it all into a One America policy, you could send it to the transfer annuity. We'd send $200,000 to the One America and $200,000 to wherever else, whatever other company you wanted it to go to, and facilitate that 1035 for you. We have a medically underwritten SPIA. Okay, not exciting, but if someone is liquidating funds to pay for care and they're less healthy and they could get a higher payout, it's a great opportunity. We also have a parking place for folks that may have old annuities that are maturing that writes to age 99. So if you got older clients is one option that they don't want to annuitize or take the full lump sum and want a place to park it, they can do that. If you have somebody that's less healthy, maybe I had a case the other day, a lady asked me, has somebody with Parkinson's but is not super unhealthy yet, but obviously will not qualify for any kind of care, is going to put the client into the legacy care for now, park it in the fixed annuity, because when he does become worse down the road and annuitizes into our immediate care plus, that's what ICP stands for, annuitizes that legacy care into the immediate care plus, we are going to add 5% to the total. So if it grows to 100,000, once he goes to annuitize, the payout's going to be based on 105,000. Okay, so we also have some niche products beyond lifetime benefits, taking qualified money, continual pay. We have a lot of options, guys, in regards to what your clients can do. So I appreciate you guys hanging on. It looks like almost everybody stayed on for most of it. I know it's 11:45, so Kathy, that is my dog and pony.
Wonderful. You did a really good job. Thanks a lot. I do have some questions, though, so you've got some people out there thinking. I don't know if you can see the questions or not from our screen, but are you still doing the policy with reverse underwriting where the client pays in a larger sum of money and the company will take over paying the long-term care nursing home bill?
I don't know that I can't see the questions, so
Okay.
I'm not sure I'm familiar with exactly what you're asking, so I apologize for that. I haven't heard of that. But I can find out for you.
Okay. I can send the question over to you in a different email just so you see it. I don't understand it either, so Daryl will get back to you on that.
Okay.
Some people have asked, is this webinar being recorded, and if so, can I have a copy? Yes, this is being recorded. If it turns out, we'll go ahead and email you a copy if you ask for it. I do have a lady asking, are there any classroom type training for these products? You personally don't have anything that does that. You know, we do webinars here in our office, unless you have something I don't know about. Do you, Jay?
Not at this
Personal
point.
training? Okay.
No, we're looking at setting something up first part of next year, possibly, so stay tuned for that, but definitely willing to do webinars if I'm in your area, one-on-one webinars. We want to make sure everybody is up to speed and comfortable with the product as possible. So anything we can do outside of that, definitely let us know.
And then we can help you here at Premier too to help you get going, run you some options and show you things and go over the illustrations with you and make sure that you're comfortable when you're talking to clients. Someone else was saying, may the plans, oops, a whole bunch of questions just popped in. It just jumped my board quite a bit. Okay. May the plans be partnership qualified with long-term care rider?
No, they're not partnership. Part of the partnership program. One, because the base policy is life insurance and everything else. You can add the inflation rider or inflation to the rider, which the big thing with the partnership is the inflation piece. But the fact that our benefits are lifetime, I think kind of helps combat that in regards to whether it's partnership or not, because we're creating benefits that you can't outlive.
Wonderful. And is there a cost of living benefit? If not, how do you justify owning but may not be used for 20 or 25 years?
Well, and that's a good question, and here's a reason that I like that. Is one, yes, there is, if you want to add a 2, 3, or 5% inflation to the rider, you absolutely can. So there is a cost of living adjustment. One thing that we've done, though, and this is where you guys need to contact Premier, because they can show you the numbers and show you more comparisons of something with inflation, something without inflation. But because you can advance the death benefit over a 25-month period, remember I can advance it over 50 months, 33, 25. For example, in my case, remember I only had a $200,000 death benefit, but doing it at 4% created an $8,000 a month day one. If I would have looked at a similar policy and added the inflation because of the cost, and it would have taken me almost 15 years, I think, to get to the $8,000 amount, I thought it was more beneficial just based on my own health background and family experience. I would rather have the $8,000 day one than waiting 15 years with an inflation rider to get to the same $8,000. So that's the good thing about Premier, is they can kind of show you the pros and cons of both, but it is available if you want to add it. But just as you can imagine, there's obviously a little higher cost when you add the inflation rider.
Wonderful. Please send me the recording. We'll go ahead and get the recordings out. If anyone's interested in contracting requirements, let us know. We can go ahead and work with you on that as well. The the agent that asked that first question, he's left this, so I'm going to make sure that we get back to him on that and what the deal is there, because he asked another question. Will we have access to this webinar for refresher? Yes. Where can I find a marketing materials and or client-focused ads for this product?
There are some materials out there. Again, you can contact Premier. They've got access to a website that has a lot of the marketing material. We do have some client-approved pieces. So, and it's different products have different pieces. So, for example, if you really wanted to market the Asset Care 4, which is our continual pay product, kind of our looks more like traditional long-term care, we can see what we've got and get you what you can. Which brings me to a point. I did not bring this up, but that continual pay policy, that Asset Care 4, that's been around since 1993, guys. Even though the hybrid world is new, that product's been the same product, and our pricing has been the same. It was the same cost in 93 as it is today. And the interesting part is traditional long-term care insurance costs have gotten very close to what our cost is on that policy. So, but we can get you materials. Let us know which product that you would really like to start working with to get your clients interested.
Okay. And then this is a good question too, is I have an agent out here that says I'm contracted for life and health only in Pennsylvania. Do I need additional licensing to get contracted and sell this product? So my rule of thumb, and again, you can contact Premier on that. My rule of thumb to answer that question is yes, because the majority of the states require the long-term care CE to be able to sell our products, because remember, our rider is true long-term care insurance, has a tax deductibility, has the ability to have HSA money pay for it. So you've got to have that long-term care CE, which is not super difficult. Now, I think there are a few states that don't necessarily require it, but again, rule of thumb, get it, because more likely your state does require it, and it's better to have it than to not have it. I do know there's a couple states out there too, is once you've done it, you don't have to do it again. So then some states do require like an additional 4 hours every year after that. But at our website, we do have the information by state there that's available for you, so we can also go ahead and get you hooked up with that information. We'll email that over to you. If there's any other questions, please let us know at Premier. Just call in and ask for a hybrid marketer. 1-800-365-8208. We're here to help you run quotes, help you with contracting, anything we do to help you. Jay, you did a phenomenal job as normal, so thanks very much for helping us and joining us today.
Thank you for having me.
I appreciate that. Everybody have a great day, and we'll take care. Talk to you later. Bye. Bye, Jay.